Look, by the end of this video, you're going to know exactly how to build the perfect taxable brokerage portfolio for 2026 without making the same costly mistakes most investors make every single year. Because here's the truth nobody talks about enough. In a taxable account, it's not just about how much money you make, it's about how much you keep after taxes. And that difference can completely change your future wealth. Most people treat taxable brokerage accounts exactly like retirement accounts, and that's where the problems begin. In a Roth IRA or 401k, your investments can grow with major tax advantages. But in a taxable brokerage account, the IRS is involved the entire time. Dividends get taxed, capital gains get taxed, and sometimes you even owe taxes without selling anything. That's why building the right ETF portfolio matters so much more than people realize. One of the biggest traps investors fall into is chasing massive dividend yields. Social media has convinced people that a 10% yield automatically means a better investment, but that's not always true. Many high-yield ETFs generate non-qualified dividends, which are taxed like ordinary income. So if you're in a higher tax bracket, you could lose a huge chunk of those payouts to taxes before your money even has the chance to compound. That's why smart taxable investing starts with tax efficiency. The goal isn't just to earn money today. The goal is to maximize long-term after-tax returns. Investors who understand this focus on ETFs that combine growth, low turnover, qualified dividends, and long-term compounding power instead of simply chasing income. The first category every taxable portfolio needs is a value or dividend ETF focused on quality businesses. These are companies that tend to survive recessions, inflation, and market panic better than most. Think healthcare companies, consumer staples, industrial leaders, and stable financial businesses. ETFs like SCHD and VTV are popular because they provide stability while remaining relatively tax efficient compared to many high-yield income funds. This part of the portfolio acts like the foundation during market volatility. When growth stocks crash, quality dividend companies often hold up better, and over time, reinvesting those dividends creates a powerful compounding effect. Every dividend buys more shares. Those shares generate more dividends, and eventually the portfolio starts growing faster on its own. The second category is your foundational ETF, which is arguably the most important part of the entire portfolio. This is where broad US market exposure comes in. ETFs like VU and VTI give investors access to some of the largest and most successful companies in America. Historically, broad market investing has created enormous wealth for patient investors through crashes, recessions, wars, and economic uncertainty. The reason these ETFs are so powerful is because they evolve automatically with the economy. Weak companies eventually fall out of the index, while stronger companies rise to the top. You don't need to constantly predict winners because the market does that process for you over time. That's why simple index investing continues to outperform most active investors in the long run. The third category is international exposure. Now, international stocks have underperformed US markets for a long time, and many investors completely ignore them because of that. But diversification is about protection, not predicting the next winner. ETFs like VUS spread your investments across thousands of companies outside the United States, reducing the risk of depending entirely on one country's economy. I still wouldn't make international exposure the biggest part of the portfolio because US companies have historically delivered stronger returns, but having at least some global diversification can help balance risk over the long term. It's less about maximizing performance and more about avoiding concentration risk. The fourth category is broad growth ETFs. This is where the portfolio starts adding more aggressive growth potential. Funds like QQQM, SCHG, and VUG focus heavily on technology, innovation, artificial intelligence, cloud computing, and fast-growing businesses that are shaping the future economy. Over the last decade, these types of ETFs have dramatically outperformed the overall market. Of course, Higher growth also means higher volatility. These funds can drop hard during bear markets, which is why balance is important. But for younger investors with long time horizons, broad growth ETFs can significantly increase long-term portfolio returns because they capture some of the fastest growing companies in the world. The fifth category is aggressive growth, and this section is optional depending on your age and risk tolerance. This includes sector-focused ETFs like semiconductors or advanced technology funds. ETFs such as SMH and VGT have produced incredible long-term returns, especially during technology booms, but they can also experience brutal declines during market downturns. That's why aggressive growth should only be a smaller portion of the portfolio. It's designed to enhance returns, not dominate your investments completely. Investors with longer time horizons can usually tolerate more exposure here because they have more time to recover from volatility. Now, portfolio allocation matters just as much as ETF selection. Younger investors in their 20s or early 30s often benefit from heavier growth exposure because time is their biggest advantage. Investors in their 40s and 50s may shift slightly toward value and tax efficiency as income rises and retirement gets closer. And investors near retirement usually prioritize stability, qualified dividends, and lower volatility to preserve wealth. The biggest mistake investors make is focusing only on returns while ignoring taxes and long-term efficiency. A portfolio that looks amazing on paper can quietly lose massive amounts of money to unnecessary taxes over time. Even losing an extra 1% annually can turn into hundreds of thousands of dollars over multiple decades because that money never gets the chance to compound. That's why successful investing is usually much simpler than people think. It's not about constantly chasing the hottest ETF or trying to predict every market move. It's about building a diversified, tax-efficient portfolio and staying invested long enough for compounding to work. A taxable brokerage account can become one of the most powerful financial tools you ever own because it offers flexibility that retirement accounts don't. There are no contribution limits stopping you from investing more, and there are no penalties for accessing your money early. That flexibility can become incredibly valuable if you ever want financial independence before traditional retirement age. But to fully benefit from that flexibility, you need a portfolio designed specifically for taxable investing. Focus on low-cost ETFs, qualified dividends, broad diversification, long-term growth, and tax efficiency. Avoid blindly chasing yield. Avoid unnecessary trading, and give your investments time to compound. Because at the end of the day, the investors who build real wealth are usually the ones who stay patient, stay disciplined, and keep their strategy simple while everyone else gets distracted chasing short-term excitement.